Time after time, crashes have been inevitable, investors naively believing the market will continue in its relentless bullish uptrend have failed countless times.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go.
Many have tried to create indicators to define market condition.
Everybody, we're trying to find a bottom. We're trying to, as a floor broker, I see stocks trading 10 points below where they traded Thursday, and I'm saying this has to be the bottom.
We're down over 16%.
With only one gaining popularity by many investors, one that is simple enough to be timeless, and one that is even vouched for by one of the greatest investors himself, Warren Buffett. So after 13 years of the market going up, a question is raised into concern.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Are we in a stock market bubble? The Buffett indicator explained. To start off, let's figure out how exactly the Buffett indicator is measured. The indicator essentially takes the total valuation of the US stock market and divides it by the total output of the US economy. The theory behind this is that if a company is worth more than what they make, poor returns are bound to happen. The specific measurements used today to value the stock market is the S&P 500, or sometimes the broader Wilshire Index 5000 instead. To value the total economy, the US GDP is used. By dividing the valuations of the securities market by the total valuations of the US economy and multiplying that value by 100, you can get the percentage that defines the valuations of the entire market. Now let's talk about what this percentage means. 100% is the fair value, as the stock market is representing 100% of what the total US economy is outputting. Anything above 100% would indicate the stock market being overvalued, and likewise, anything under 100% would indicate the stock market being undervalued. According to Warren Buffett, if the ratio is between 70 to 80%, it will be a good time to buy, as the stock market is at a discount. On the other hand, if this value is 200%, quoting Warren Buffett, you're playing with fire. Today, the Buffett indicator values the stock market at a whopping 233%, meaning that the stock market is more than twice the value of what the US economy is outputting. It can be clearly seen that today's market is very overvalued. However, if there's one criticism to the Buffett indicator, it's that it doesn't take into consideration other asset classes that might affect the stock market as a whole. For example, one of the biggest cases today is the bond market. Because of the abnormally low interest rates today,
The Reserve is keeping interest rates unchanged and will maintain asset purchases at $120 billion a month.
the bond market doesn't have too good of a return, which forces investors to pump up the stock market. This could explain why today's market valuation is mind-bogglingly high. This can lead the stock market to higher levels than ever seen before, as it's the only investment that investors might get a good return on. In conclusion, the Buffett indicator is a ratio between the valuations of the stock market and the valuations of the US economy. It can be a useful tool to gauge the valuations of the overall securities market, and if used correctly, can help you prepare for present and future market conditions. And that is all. If you want more of these videos, hit the like and subscribe button, and have a wonderful day.